You probably know about the recent $1.6 billion bet Michael Burry has made. People are calling it the Big Short too, and trying to determine what will happen as this bet is against the S&P 500 and Nasdaq 100. So, is this really a Big Short too? Let's find out in this video. The information about this bet came out when Michael Burry's firm filed the 13F form. According to the 13F report, in the second quarter of the year 2023, Burry bought $886 million worth of put options against SPDR S&P 500 ETF Trust and $700 million of put options against Invesco QQQ Trust ETF. The information was revealed on August 14th, and Q2 ends on June 30th. So far, nobody knows the reason for this bet, and everything you saw about it is speculation. Everywhere in the news, it was said that Michael Burry held a $1.6 billion short position on the stock market crash. They were also claiming that it was almost 93% of Burry's portfolio. So, did Michael Burry risk 93% of his portfolio by betting $1.6 billion on this short position? The answer is a big no. Once you understand this, you will know how the media manipulates and creates panic among investors by creating news. First, he did not risk 93% of his portfolio. Scion Capital's total assets under management are around $238 million, which is significantly less than $1.6 billion. Now, the reporting in 13F is as follows. In the report, you can see that the market value is $886 million for SPY puts and $700 million for QQQ puts. Each trade has 2 million shares. In a single put contract, there are 100 stocks. So, Michael Burry bought 20,000 contracts for each bet, totaling 40,000 put option contracts. Overall, this all looks right and makes you feel that Michael Burry put $1.6 billion on the line. The reality is completely different. The reporting in 13F is done on the strike price of the stock and not on the actual price of the put option of the stock. For example, if a stock value is $100 in the derivatives market, the put option contract for this stock has a value of $1. If you want to buy a single put option contract for this stock, then the money you will pay is $100, as the put option value for the $100 strike price is $1, and each contract has 100 shares. But what the media reported was the strike price. It is usually considered a notional value to calculate the total value of an asset. So, they counted the value of each put option as $100. So, the notional value is calculated as follows. Notional value equals number of contracts times 100 times strike price. So, the notional value for a single put option contract goes to $10,000. But in reality, you only paid $100 for it. So, Michael Burry bought SPY 20,000 put option contracts at a strike price of around $427 for the S&P 500. The value of the single put option contract was around $5.30, so he paid around $10 million for this. Now, the strike price for the SPY was around $427, so the notional value was around $886 million. The strike price of QQQ was about $350, and its put option was selling at around $7. So the 20,000 put option of QQQ would be around $14 million. Basically, Michael Burry bet around $25 to $30 million on those put options. Also, these option contracts he bought were in the second quarter of 2023. He probably has sold them now, or might have bought out-of-money positions for November or maybe in December. Nobody knows this. You can only figure this out when his firm, Scion Capital, files its next 13F. One more thing, after the 2008 crisis, Michael Burry has made many predictions that markets will fail, but his predictions failed. The thing is that Burry has become so famous in the finance world, anything he does is researched way more thoroughly and looked upon from every angle. So now it's completely different from the pre-2008 era when nobody knew what Michael Burry was up to. Nowadays, everything he does is studied meticulously, and everyone tries to find the agenda behind it. So if you understand this, then you should always remember that you need to do your due diligence when there's a panic in the market. And you can use these panic situations to your advantage by accumulating good stocks for the long term when their prices drop because of such things. During the 2008 crisis, nobody believed in Michael Burry, but in the end, he came out as a winner. To know how Michael Burry figured out the potential crash of 2008, you should watch this video.